and welcome to the Tuesday Live. My name is Kenneth Mraz. I'm a strategy specialist with Zang International. We're streaming out there to Facebook, YouTube, Instagram. We're streaming to the multiverse today. So everybody out there watching, appreciate you. I'm filling in for Lynette, and again, sitting at the desk of the greatness here. So I'm trying to fill in the spot good. She's just had 2 engagements that she did last week. Really great conferences. I know that the video is up on the channel for YouTube at the Red Pill Expo that she did. And so she's just feeling a little under the weather, probably from all that traveling. So I'm here to fill in today. And yeah, I just want to kind of dive right into something today because, I get this question all the time as a strategy specialist. And people ask me, Kenneth, what actually happens to my real estate, my house, my investment properties, if we see a currency reset or hyperinflation? And, most people think real estate is the ultimate safe haven. But when you actually look at history and what happens to housing during a banking crisis, there's a bit of a pattern that emerges. So what we need to do is just take a look at, how these things play out, because really to know where we are going, we have to be honest about where the real estate market is right now. For the last 30 years, housing prices and interest rates, they operated on a very simple rule of gravity. As interest rates went down, house prices would go up, right? Kind of like a seesaw. Low interest rates on this end, high house prices on this end. Well, we could think of the real estate market like a giant concrete slab that's sitting on top of a hydraulic lift. The hydraulic pressure inside that lift, that's the low interest rates. So for 30 years, the Federal Reserve pumped more and more pressure into that lift, and it was pushing that concrete slab higher and higher. But basic physics tells you that if the hydraulic pressure gets pulled, then that slab has to go down. Can you rewind it just a little bit, please? Sorry. So what we need to do here is take a look at what really happened during 2008, right? The Federal Reserve started having to pull the hydraulic pressure out of that lift. And as the housing market started going down, they stopped it from finding its true bottom, because they went and they just purchased a bunch of mortgage-backed securities. If we actually fast forward into 2022, we see that the Federal Reserve did that same thing because they actually raised interest rates faster than they had in modern history in 2021. But that means, by all economic means, the housing prices should have collapsed, but they didn't. Why is that? Well, it's because the Federal Reserve actually purchased more mortgage-backed securities from 2019 to 2021 than they did from 2008 to 2010. And I think we have actually a screen here that will show you that how fast they purchased these. So you can see here, you see that there's that first kind of initial bump in 2008 into 2010, but look at the second gray bar from 2020 into 2021, 2022. So what they did is they basically just created a fragile government scaffolding, okay? Really, they created a fake demand. The housing market, it's no longer supported by reality. So what happens to your home's value when a currency fundamentally breaks down? Well, before we even hit hyperinflation, we usually see a credit freeze. And people love to talk about their home equity. We naturally want to assume that the wood, the concrete, and the land are what hold the value. But guys, in a fiat money system, that's just not the case. Your home's value isn't a reflection of the property. It's a reflection of the cheap credit provided by banks. If you want to see what happens when that credit freezes, Look at Japan in the 1990s, right? Back then, the real estate bubble, it was so massive that the grounds of the Imperial Palace in Tokyo were technically worth more than all the real estate in California combined. And that wasn't real wealth. I call it phantom equity, right? It looked good on paper, but it wasn't doing anything. So when the Bank of Japan was forced to raise rates, the credit cycle broke. And that equity didn't just correct itself, it evaporated. It was a mirage that was trapped inside the drywall. So families and companies both were left holding massive levels of debt on assets that lost 80 to 90% of their value. Because here's the hard truth. When banks stop lending, your buyers disappear. So your house becomes completely illiquid. You can't spend the stucco and you can't eat your equity. So let's talk about the hyperinflation phase then, because this is where a very dangerous illusion takes place. And this is what we need to be looking at, because at Zang International, we're all about looking at currency life cycles. That's what Lynette has spent a lot of her life studying. A currency life cycle works in a pattern, and part of that pattern is hyperinflation. When the general public loses all confidence that is left in the actual currency, the hyperinflation starts taking place because it's the end of that currency's life cycle, and they need to replace that currency. So let's say hyperinflation hits and the price of your house, it might skyrocket. I mean, a home that costs, let's say, $500,000 today might suddenly reprice to $50 million on paper. So people might see that and say, well, hey, I'm rich. I'm a multimillionaire. But this is just a mathematical trick, right? Your house isn't gaining value. It's that the yardstick that you're using to measure your house's value, the dollar, is shrinking. What's the actual purchasing power of that home on the global stage, right? It plummets. And we did just see this play out in Venezuela. Luxury apartments in the Caracas that would sell for about 2 million US were suddenly not even able to fetch 300,000. And we have another slide here actually that'll show. This is from a actual reporting agency for Venezuela. They showed that the loss of the value of the homes in the Caracas in Venezuela when they're going through their hyperinflation. And why does this happen? That's because the mortgage market goes bust. No bank is going to give somebody either a 30-year fixed loan or even an adjustable rate loan when the currency is losing 20, 30% of its value every week. And if you're a landlord, you can forget it. You know, you might lease out a property for $2,700 a month, but by month 3 of hyperinflation, that $2,700 might not even buy you a tank of gas. So you're just operating at massive losses. So here's the thing that most people completely miss when they plan for the future. Banks are the bedrock of world governments. When the banking sector faces a total collapse, the government doesn't just shrug its shoulders and let the banks fail, right? I think we all understand that that's kind of what happened in 2008. The banks got bailed out, so the government steps in, and they can change the rules of the game while you're still playing it. History shows us that this would happen time and time again. In the 1920s in Germany, during their hyperinflation, people paid off their mortgages with worthless paper money. They threw a giant party thinking that they had beat the system. But when the government issued a new currency to fix the economy, they retroactively reinstated parts of those mortgages to save the banks. So let's take a second to kind of really pull back the curtain here. Because to understand how the government can just reinstate a mortgage, you have to understand how a bank actually looks at your mortgage contract. Now, when you and we look at a mortgage, we see our house. You see your kitchen, your backyard. This is your family's shelter. The bank doesn't see that. To a bank, your mortgage is just a line item on a ledger. It's an asset that produces a very specific, predictable stream of cash flow for them over 30 years. And that's it. So, again, going back to if we enter into hyperinflation, the currency's collapsing. Suddenly, you could take a couple of pieces of gold or a couple of worthless paychecks and pay off your entire 30-year mortgage in an afternoon. So from your perspective, you've won the game, right? You own your house free and clear. But we have to look at it from the bank's perspective. If their ledger was just wiped out, they also just got paid back in monopoly money. It's money that is basically worthless, right? So if everybody pays off their mortgages with completely worthless currency, the banks lose all of their cash flow producing assets that are sitting on that balance sheet for mortgages. And it's a big part of what could make them become insolvent. So the government cannot let the banking system fail because the banks are the mechanism the government uses to fund itself. So they can declare a bank holiday. They can freeze out the system and they can invoke emergency powers. And we've seen this playbook before as well. In 1933, they passed the Emergency Banking Act in a matter of hours. During the 2008 crisis, they rewrote the rules to execute massive bailouts. Today, the legal framework to save the banks through bail-ins, it's already sitting right inside the Dodd-Frank Act. When a currency resets, the government has to bring out a new currency. So what about that mortgage you thought you paid off with the old worthless money? So again, to save the banks, the government can just pass an emergency revaluation act or recapitalization act. They can just pass a law that says any debts that were paid off during that hyperinflationary period were paid with a defunct currency. So to stabilize the banking sector, those contracts are hereby re-evaluated. So you wake up on a Monday morning thinking you own your home free and clear, but by a Friday afternoon, the government has passed that emergency legislation stating that you now owe the bank a newly adjusted balance to keep the financial system from collapsing. And they don't have to ask for your permission. They don't have to check your original mortgage contract. They just changed the laws under the umbrella of a national financial emergency. And here's the real kicker. The thing that most commonly would force people out of their homes is actually property taxes. Because real estate is a fixed, hard asset. You can't hide it. You can't move it offshore. And that makes it the easiest target for taxation. So let's really think about it. If the government is going broke and your home's value on paper just became $50 million, what would stop the government from adjusting your taxes based on your new unrealized gains? I mean, historically, people don't really lose their homes in a reset because of the mortgage. They lose their homes because they can no longer afford the skyrocketing property taxes. And once you fall behind on those taxes, the government has the full authority to step in. They can place a tax lien on that house. They can take your property right out from under you. So let's look at this really impartially. Being heavily leveraged in debt during a currency reset, it might actually leave you exposed. When a reset happens, the government can just rewrite the rules, banking contracts can get restructured, and everyday people get trapped inside the liability that the system has built. Do you recall anyone ever going to jail for the 2008 global financial crisis? True safety is found in a sound money strategy that sits completely outside of this brittle, rigged system. And we account for all of these different possible scenarios when we're building this strategy out with you. Property taxes is something that we consider. your mortgage being paid off is something that we consider. Having a little bit extra put aside just in case they reinstate those mortgages is something we consider. Is it something that you've ever considered, or your regular financial planner? Have they ever considered that for you? Probably not. So if you're kind of starting to realize that your current plan might have some weak spots, just don't wait too long, right? Don't wait for the too big to fail banks to change the terms of your contract. You can take action while you still have options. So there is a link in the description. You can scan that QR code that's on the screen, or you can just give our team a call. We'll sit down with you. We'll do a quick review of your current setup, look at your specific risks, and we'll just show you the exact way to have a strategy to protect your wealth. So you've got a choice. You can get a strategy in place today, or you can roll the dice on this traditional banking system and hope things might be a little bit different this time around. And with that, we can go ahead and take some questions. So it looks like we have Mud Puppy Forge. He says, what are your thoughts on small fractional gold and silver, like 1/10 of an ounce and smaller? Are they worth stacking, or should someone wait until they can purchase a larger fraction? That's a great question. One that honestly we get a lot because everybody is wanting to make sure they can do the best with what they have. When it comes to fractional gold and fractions of silver, that is absolutely the bedrock of a good barter position. So we have to look at this as like a two-step kind of process, right? You've got layer one, which is your barter position. This is the kind of stuff that you would be expected to use during hyperinflation to maintain your standard of living. And I think that fractional gold and fractional silver absolutely is the best thing to have for that barter position. Really, having like a 10-ounce bar of silver, they're not very liquid in that kind of situation. And it's okay to have some 1-ounce rounds of silver, but I love the constitutional stuff, the junk silver, quarters, dimes, half dollars. It's just great to have that because you have diversification inside of your barter position. And same with the gold. Truly, having fractional pieces of gold can be good to have in that barter position. Even if there were to be some sort of overt confiscation of gold, if you have little fractional pieces of gold, you can just turn that in for fiat dollars. That just adds that first layer of defense because you're going to want to use those dying fiat dollars first before you even touch your silver. So it kind of gives you options either way. So yeah, I think that, if you've got the ability to do it, don't feel like you're not doing enough by getting fractions of gold or silver. It's part of the strategy and it's very viable. Yeah. Then we have Miramore says, hi, Kenneth and all. On another video, you said paying off mortgage loans, etc., when currency devalued resulted in the government in Weimar reassessing debt and needing to repay it anyway after the reset. Is that right? Because that is the Zang plan. Did I not understand? Right. So, yep, just like I talked about too with my little recap on this, part of that is we want to make sure that we are having a plan in place for, hey, what if they even do reinstate some form of a mortgage? We want to make sure you're going through the currency reset debt-free. So any fixed rate debt is taken care of, but we can also account for if they do reinstate mortgages, having that little bit of extra as a safety net. And if they don't, great. That's even better for you, right? You're holding on to more purchasing power for the other side of the reset. But if they do, then you're covered. So, and then Dr. Gloopyglop says, hi, Kenneth. I loved your mega IPO video. Thank you. Appreciate it. You mentioned how technically nobody owns stock since we don't get the certificates, but does that mean that our brokerages are holding the certificates? So the way that the current majority of stocks are set up is right. The actual stock is held in what's called street name. That means that your brokerage, you can kind of think of your brokerage as being a single apartment inside of a giant apartment building. And Seed and Co. is who owns the apartment building. Um, it's held by Seed and Co. So they own the property. Your financial planner, your brokerage account is sitting there as a little apartment inside the property that's owned by Seed and Co. And your brokerage, they are technically the actual owners of record with that. But really, Seed and Co. is the ultimate. They have like the top, hierarchy, legal ownership of it. So, yeah, when we're talking about looking at like if you pull up your app on your phone, it's very easy to think this is my money. You see a number on the screen with your brokerage account, or you see how many shares you own of Microsoft or whatever. But the reality is you don't own any of it. Even the balance that's in that brokerage account, you have to remember that number, the government has an embedded claim on that number that we just call it deferred tax, right? They own 30 to 40% of that number anyway, right off the bat. But it's a system that's been put together to make us feel comfortable with a number on a screen. And really, that's the biggest thing about our strategy. I mean, I tell people, hey, have you ever thought about why just everyone isn't going out and doing our strategy, buying precious metals? Well, it's because it requires you to do a full 180 from everything you've ever been told about building wealth or money management. And it really requires you to take full, unapologetic control of your own wealth. And a lot of people are they're in this illusion, it's like a hall of mirrors. They look at their brokerage account, they look at their bank account, and they're like, no, it's mine. I can spend it whenever I want and I can do whatever I want. But we're seeing that change, right? BlackRock, Blue Owl, Morgan Stanley, Deutsche Bank, and others, they're doing curbing of redemption requests. That's just jargon, legal language to say they're denying people being able to use that money because it's not yours. The stocks aren't yours. The funds aren't yours. You've just given a free loan to these companies. So, yeah, the brokerages are holding, the certificates, are Seed and Co. really, who's the owner of think of it as an apartment building. They're the ones that own everything in the apartment building. But great question. So we've got Jade Deha from Facebook. Is the only protection if you have gold as well as silver? If gold is above your financial investing ability, will only investing in silver be of any benefit? So, yeah, that's a very valid question. And again, it goes back to our strategy being a two-tiered strategy. Silver, mostly, is what you want to have for your barter position. If we want to make sure you can maintain your standard of living while the dollar is collapsing. That means you're still able to put food on the table, make sure that the bills are paid to keep the lights on and the roof over your head, make sure the property taxes are paid, like I just talked about earlier with what happens to reassessing property taxes, right? That's the big thing. A lot of people don't understand or don't expect that your local government could just say, hey, you owe us way more in property taxes. If you can't pay it, they put a tax lien on the home, and they'll kick you out. They'll take the home with the land and the home from you. So, being able to pay those property taxes, having an emergency fund, because you never know when, a major medical emergency might pop up. Maybe you need to get a new car or get a major repair on your vehicle. Something on the house needs to get fixed. You just never know. So having that emergency fund, all of that is part of your barter position, which again is majority going to be in silver. So yes, it's of benefit because holding precious metals, I don't care if it's a roll of junk silver dimes. it puts you ahead of a large majority of people out there, because most people are stuck in that, again, that, kind of hall of mirrors. They don't see any benefit of having precious metals, but investing as much as you can, and really, investing, I don't look at it as investing. I just look at it as you're doing a currency exchange, right? You're taking your fiat paper liability and you're just exchanging it for real sound money. So yeah, doing that exchange is of benefit. Even if gold is above your financial ability, you just do what you can with what you have. And again, you can always give a call to our team. You can scan the QR code that's on the screen. It'll take you right to the booking page, and you could just have a quick 5-10 minute conversation with one of the strategy specialists here to go over everything for you. It's very straightforward, but I think having an actual black and white plan in your hands is the first real important step to knowing you're doing the right thing. So, a great question. So, Stacking Surfer says, when vaulting, can pre-33 gold coins be insured at the retail cost of the coin? It's a really good question too. That is actually one of the most interesting things about the pre-33 gold. You can get insurance policies on private vaults. It's going to be insured for, whatever the market value is at that time. If you're keeping it at home, though, here's an interesting thing. If you have bullion at home, you can only get that bullion covered under a rider policy for your homeowner's insurance, and it covers basically nothing. I think most of them are up to like $2,500. That's barely even a half ounce of gold, right? For bullion. But the pre-1933 gold, there's actually specific dedicated insurance policies for them that will cover the value, and it can always be reassessed as well, because we expect that, as the currency is being reset and we're moving into that new form of currency, the gold gets revalued historically, and that's that bullion, right? The bullion is a financial commodity, kind of sits in the same bucket as a stock, but the government uses it to pay their debt, and that revaluation is going to have a massive impact on the value of pre-33 gold, especially if there is an over confiscation of the bullion. That means that the pre-33 gold, if its historic exemption is any indication, would be the only asset that people would be able to go into in a flight to safety. And then it just becomes supply and demand. And so being able to have an insurance value on that is pretty important. But yeah, so you can definitely insure them at the retail cost, and you can always just revisit that insurance valuation to make sure you're getting full coverage on your pre-33 gold. And then Gail Old says, I have Social Security and monthly pension deposited into my bank. So what do I do to close my bank account and receive payments if I still go into stable coins, and how? So, or receive payments still if I go into stable coins? Well, I mean, that's a good question. If you're trying to go into stable coins, as of right now, your only option is you take your fiat, paper liability. It's like a digital claim check, really. That's what your bank account is. And you're going to have to just take it and turn your bank account money into stable coins. If you want to close your bank account, if they're going to give you the option to receive like an actual Social Security and pension check, like a paper check, then same thing. You'd still have to go to your bank to redeem the check, get the fiat, and then get the stable coins with it. But I think, Gail, you've got an important point, because I would expect, and I don't have I do have a crystal ball, but I don't have a crystal ball that I can say for certain, but I would expect that things like your Social Security and your pension will be some of the first things that actually get converted directly to a stable coin. So the government will just be like, hey, you've actually got a new digital wallet, or maybe your bank will just say, hey, we've partnered with the government. They've just created this digital wallet for you. Now your Social Security and your pension are just going to be turned into, like, you're just getting stable coins as payment. So I could see that being a possibility. But if you wanted to close your bank account and receive the payments still, you'd have to see if they allow you to get a paper check mailed to you. But I don't know. It looks like the way everything's heading, they're going to just want you to get stable coins anyway. So you'll have to keep that account open. And then Colleen Allen 3382 says, if your property tax is around $1,000 a year, what specific pre-33 coins would be good to collect to make that payment? It's a really good question. I would say give us a call or scan the QR code on the screen, Colleen, and we can have a quick 5-10 minute conversation. One of the strategy specialists can actually go and see what would fit you best based on your needs and where you're at, because we need to account for if there is a revaluation of your property taxes. We want to make sure that you're covered. We don't want anybody to feel like there's any kind of weak spot in the armor. And so just having that quick conversation would be the best way to do that, because then you've got a black and white plan in your hands. We can just email you a copy of the strategy directly, and you'll know exactly what you're looking at. And the great news is, too, we just so happen to have access to pre-1933 gold coins. So we can help you fulfill the strategy as well. And it's a super easy process. So, yeah, we're here for you every step of the way with that. And WOTD2 says, genuine question. Wouldn't an event similar to Weimar's mortgage revaluation throw a huge wrench into the wealth transfer endgame strategy? Any tips on how you would navigate this? Thanks. I don't necessarily see how it would throw a wrench into anything, because when we talk about wealth transfer, that's what the revaluation of gold is. That's the wealth transfer. When we're on that new form of currency, that's the wealth transfer. That's why our entire strategy is built around having a seat at the table. And we believe that that is through having the pre-1933 gold and really just having your own sound money that you're holding in your hands. But the whole goal is to have that wealth, have some of it at least, transfer our way, not directly just into the hands of the 1%ers. So that's the wealth transfer. I mean, as far as throwing a wrench into it, what it is it's just it's an accounting trick. That's what a reinstatement of mortgages would be, because the government would wait until we're on that new form of currency and the wealth transfer has already occurred before, at least historically, if Weimar Republic is any indication, before they would do a reinstatement of a mortgage. So, and again, that's just to keep the banking system afloat, to put debt back onto their ledger, because debt is an asset for a bank while it's a liability for us. And cash, inversely, right? It's something that we think of as an asset for us, but it's a liability for the banks. So, yeah. And then Zang fan, okay, that's cool. We like that. Says, I'm confused with the explanation of the Revaluation Act in 1923, where the people who had their homes paid off prior to the reset also affected and given new variable rate mortgages in the new fiat currency, or is it only the people who paid their home off when the reset hit who were affected? So yeah, according to what the history shows, it was when the hyperinflation had occurred. So it was at a specific point. They could put a date on it, right? Because the government is going to track all that. They know when that hyperinflation officially hits on their book. And it was from that point when people actually paid off their mortgages, again, with these dollars that just had absolutely no value. So, again, that's just we can only go by what history shows. So if we enter into that hyperinflationary period, it's going to be from that point where most likely the government would say, okay, if you paid off your mortgage in dollars at this time, then if they do pass some kind of emergency revaluation act or an emergency banking act, that they would reinstate mortgages from that point. And again, it was at a portion of what the actual value in gold for the mortgage was in Germany. So they could easily do that same thing though, because they've got baskets of currency that they could use to try and put that as like weigh the mortgage value against that, or they might just weigh it against the new currency, whatever the value of the new local currency would be. So again, it's something to at least consider and know that this happened, because that could be detrimental if you think that you're going to go into this new form of currency with free and clear real estate, and then they say, well, hey, actually we have to reinstate part of that mortgage. We don't want you to have that liability. So if you haven't thought about how you could overcome that, again, I would say just give us a call. There's a QR code on the screen. There's also the phone number in the description, or a link in the description, and just have a quick chat with one of the strategy specialists so they can at least have the conversation with you. So that way you just know where you're at. Because if you don't know where you're at, it's kind of hard to know where you're going. So. And then Gail Old, she's from Facebook. Thank you for watching on Facebook, Gail. She says, so what I have in cash, should I turn into stable coins or should I keep cash for now? Do we lose that at change? You say own sound money. Do you mean hold on to some fiat? Okay, so yeah, that's pretty good question. There's like two parts to that question. So the first is if you should turn your cash into stable coins. That's a personal like a personal choice if you wanted to do that. I personally would say don't. If you don't have to have a stable coin, don't do it. While we at least still have the option. Do we lose that at change? I think you're asking, do you lose your cash if you were to change it into a stable coin? Yeah, because what you're doing is, with a stable coin, you're basically just taking on a digital minted currency from a private equity corporation. They use cash to back it. They need to have cash or like some sort of treasury bond or reverse repo agreement to back that stable coin, but you aren't holding on to that cash. And then when you say own sound money, do you mean hold on to some fiat? Yes, having some fiat outside of the banking system is absolutely part of the strategy. So we want to make sure you have, 3 to 6 months of cash on hand outside of the bank, because like as far as for if you know what your monthly spending is, having 3 to 6 months on hand, just because that should be your first shield. That's what we want to burn through right away, because during hyperinflation, those fiat dollars are a huge liability because they're constantly going down in value. So having some of it so that you can just kind of burn through it is great. And then having your barter position as that next layer in the shield to burn through that's what's going to carry you through the rest of hyperinflation. So holding some fiat is absolutely part of the strategy. Knowing how much to hold. Well, how much is 3 to 6 months worth of bills for you, right, Gail? It's different for everybody. That's why our strategy is designed to accommodate your standard of living, because what might work for somebody might be way too much for somebody else, or might not be enough. So, yeah, great question though. And then we have Lewis Brown, 958. What would purchasing property in a reset look like? So purchasing property during a reset, well, again, you're not going to have any banks really, at least historically, lending out credit during a reset. So you'd be looking at having to come to the table with, well, cash. The question is, what does that cash buy you? Now, part of the strategy is absolutely to purchase property, but we do not want to do it during the reset. We want to do it after, once the smoke has cleared, because I mean, you have to think about it. The currency resets, we don't know what companies are going to be left standing. We don't know what areas are going to actually have the best value for purchasing real estate. We have to know in order to give you proper forward guidance. We don't want to guess at it. Otherwise, we're just kind of guessing in the dark. But we want to look at after the reset purchasing property. If you want to purchase it during the reset, what it would look like would be, I would imagine, kind of a logistical nightmare and probably a little risky. But after the reset, that's what Zang International is here. We're all about that. We're here for that. We are a full concierge service. Look, guys, you can go to one of thousands of coin shops down the street or online coin dealers, precious metal dealers, and they'll be happy to sell you some gold or some silver, and they'll shake your hand and be like, hey, great, see you never, right? That's not what we're here for. We're here to be a full concierge service with an exit strategy. So when that smoke clears, you call us, right? If you try to call your coin shop down the street, there's no guarantee they're even going to be in business. And, we fully anticipate having the exit strategy as a viable route for our clients to go, because we want to be here for you every step of the way through the reset and after. So, that's when we'd say, hey, we would call you if we had to, Lewis. We'd say, listen, Lewis, you've got your strategy with us. There's real estate in XYZ area. This could be a really good deal. If you're looking for real estate, this is what you might want to consider. Let's take a portion of that portfolio, turn it into the local currency, and just pay it, outright. Not even have to worry about a mortgage. So, I don't know if you've considered that, Lewis. If you haven't, again, you can give us a call. You can scan the QR code that's on the screen. It's right down there below, and it'll bring you right to a page where you just book with a strategy specialist, 5-10 minute conversation. You can see what that looks like, right? So yeah, good question though. And then we have Wolf 728. Is it possible that the government could confiscate gold like they did in 1933, so you can't use it to pay a mortgage off or pay? Can you scroll down a little bit? Sorry. Or pay taxes. So yeah, that again, very valid point. And Wolf, that's why our strategy is, a cornerstone of it is holding the right kind of gold, because you can have gold that is a financial commodity and you can kind of stay inside that traditional financial system that you're looking to maybe get out of. Or you can have gold that's in a completely separate bucket that historically is exempt from nationalization or confiscation. And then you've got the option to, pay off the mortgage, pay those property taxes. But even if you're like, hey, you know what? Nope, I would just, I'm looking at this from a bullion perspective. That's fine. If that confiscation was to come down overtly, covertly, however, you could still trade it in for fiat dollars, and you might have a good amount of fiat dollars that could get you through for a little bit. Also silver, it's not mainly supposed to be used for property taxes or paying off a mortgage. I don't know about paying off a mortgage, really. It depends on your balance. But for paying property taxes, we could look at having silver as well if your gold got confiscated. But really, it's like, why would you even want to go through all that headache in the first place, right? If you have a good strategy, a good plan set up first, then the weight of all of that stuff is off your shoulders. Doesn't matter what the Federal Reserve does. Doesn't matter if the government wants to do XYZ confiscations or nationalizations or whatever. You can just kind of sleep at night knowing you've got a strategy that, historically is going to be covered no matter what. So good question, though. Deals from Virginia, 1773 says, I'm not sure why one's real estate taxes would go up when you said 4 zeros get knocked off of wages, house values, and mortgages. Seemed to me the taxes would also be 4 zeros. 4 zeros off? Did I miss something? So yeah, that's with redenomination. So that's like an option that the governments have to basically, again, it's just an accounting trick, right? It's how they could kind of play with the books to make hyperinflation not seem as bad as it is. The problem is you're still losing that purchasing power of the fiat currency. So even if they lob off 4 zeros from the value of your home or from what your mortgage balance is, it's all about how far do those dollars get you? Because again, they're taking the yardstick and shaving it down. So, and again, that is part of, the way I kind of think of it is it's almost like a reverse stock split. If you've ever heard of that, like if you've got, it happens on Wall Street where there's penny stocks that, they're starting to fail, right? They're like 0.003 cents per share. And so on paper, to make the stock look better, the owner of the company just says, hey, we're just going to do a reverse split, and they chop off 3 zeros, and then it's worth 3 cents a share or 30 cents a share or whatever. That's what a redenomination is. So even if they chop off the 4 zeros, they still could adjust the property taxes for the new unrealized gains of what the value of your home is. But the big question is, do your dollars even actually cover the property taxes at that point? So, again, we have to account for every possible scenario, and having the barter position filled out with our strategy covers that. So if they lob off zeros or they don't. But yeah, great question though. And then BMK-V7N says, what about Europeans? You always say, call us, but can I call from Europe? How? That's a very good question. So we are a company who we want to help people around the world. Okay. I mean, we're kind of called Zang International. You can call from Europe. I know that maybe like doing a phone call is a little different, but we do Zoom calls. So if you wanted to have a Zoom with us, then yeah, it's the same thing. We go through a strategy. We have a strategy in place for everybody. And there might be some nuances because I know depending on where you're at in Europe, we might have to do a little bit of research so we can make sure we know how your local government could handle things. But truthfully, this all boils down to central banks. So globally, central banks kind of operate the same way. And so our strategy, it accounts for what a currency reset would look like because this is a global financial issue. I don't think this is a localized issue. You've heard Lynette say it's not a localized issue. The US dollar is the world reserve currency. All of the financial systems are very, very closely linked together. So this is a global financial issue. Okay. It's like when the Tour de France, when all those bike riders are taking the tight turn, everybody is grouped together. So if one person goes down, it's a domino effect. That's why this is a global financial issue. But yeah, go ahead and you can book a Zoom call with us, BMK-V7N. And, we'll have that conversation. Absolutely. And then Peter P says, what are the chances that when they implement digital currency, they will give us a limited time to convert precious metal before they make or shut off our ability to use it? Well, that's kind of what history shows us happens. There's a window. In 1933, when the government did Executive Order 6102, that's when they nationalized gold. They gave a window of time for people to be able to go turn their gold in for money. Easiest thing would probably be like opening up some sort of window at a local bank branch, and the government will just say, hey, this is the conversion window. You go up to it. If you have precious metals, you would give it to them. They would pay you whatever the government's willing to give you for your gold, right? And that's really where it comes into how can they make it look appealing to people, because it's almost like if they can offer a premium for you to be able to turn your gold in, well, some people might look at that and say, hey, that's a really good deal. I'll go ahead and do it. If gold is, let's say the spot contract price is $8,000 at that time, the government says, well, we'll give you 11,000 for every ounce that you turn into the bank. The bank is going to send it right to the government. That's the confiscation piece, or the nationalization. Then people would be very enticed to do that. But what you're doing is you're having to trade that sound money, that hard asset that is outside the traditional system, which, again, bullion, since it's classified as a financial commodity, really we have to look at, because of how the government has used the law in the past to control it, is it fully outside of that system? But either way, you go and you would be able to trade it in and get your fiat money in return, but you're getting fiat dollars that are about to lose all purchasing power. But you would have a time to convert your precious metal. Yeah. That's, at least according to everything that history shows, that's the playbook. They do the confiscation. They give you time first to make it, so they can be like, hey, we gave everybody a chance. And then that's when they can then use the law to, make it impossible to buy it, impossible to sell it, or, very painful to sell it if you want to try to sell it, or to even own it, hold it. So yeah, but good question. And then Duma Charlie 123 says, how do you feel about the 1/10 silver coins that are 999 pure? That's an interesting one. I mean, you have to look at what your conversion ratio is, because you can get the constitutional silver dimes. Just look at what, okay, how many constitutional silver dimes can I get for my money versus how many 1/10 ounce 999 pure 10th ounce silver coins can I get? Because I think that really, if you're going to go for the 999 pure, doing 1 ounce rounds makes the most sense, because then you're kind of packing the most purchasing power into a single ounce of metal. And then for any other different denominations, like, the halves, the quarters, and the dimes, the constitutional silver or junk silver might have a little bit more favorable of a conversion ratio from dollars to coinage. So that's what I'd say. And then Dr. Gloopy Glop, can you scroll down a little bit? Thank you. Says, Kenneth, back to your mega IPOs video. You mentioned how the repo market is at a fundamental low, but how is this even, sorry if you could scroll down a little bit more, thank you, possible? There's also such a liquidity problem in the system. So that's the thing. If you look, you can go onto the Fred and you can see that the overnight repo market and the reverse repo market, they're at all-time lows right now. That's because the tank's empty, right? The repo markets, you could just think of it as like a little fire hose attached right into the Federal Reserve. It's just what the Federal Reserve uses to park their debt notes in. The liquidity problem is more from over leverage inside like these brokerage accounts, because really there's a derivatives problem. there's like an unknown and unknowable amount of derivatives into the quadrillions. Lynette has gone over that before as well. amount of liquidity, amount of derivatives. So there is an aspect of, liquidity problems there, but we haven't hit actual liquidity problems in the banking system yet. When that happens, that's when you would see, like, the M2 money supply, for example, it's at all-time highs. It's just hitting higher and higher highs because there's so much money out there. And then you could look at the monetary velocity. Well, how quickly is money changing hands, right? With all that money out there, it's changing hands quicker and quicker and quicker. That is not a liquidity problem yet. But historically, that's what it leads into. And so, I'm keeping an eye on the repo markets actually every night, because I think we're going to start seeing bigger piles in the repo market because of, number one, how stable coins work, because they're going to use those short-term debt instruments, so like 3-month treasury bonds or reverse repo agreements, in order to have those on their books. So that spigot is not tapped yet, but once it starts, I think we'll see that tank fill up. And that's also going to be a good indicator of how close are we to the end of the currency's life cycle. So, but yeah, great question. Then Manuel Acosta, 370, shouldn't copper be considered too? It's going to be the backbone for all AI hardware, electric power distribution, bus bars, transformers, and electrical grids. So, I do get this question a lot. I think we all kind of get it here with copper, palladium, and platinum. Does it have a spot in the strategy? So, to just shoot you straight, it doesn't. The reason why is because those are industrial metals, okay? Even when it comes to gold and silver, silver is more primarily an industrial metal, secondarily a monetary metal, whereas gold is mainly a monetary metal, secondarily an industrial metal. But copper, palladium, and platinum, those historically, just throughout, thousands of years, are strictly industrial metals, meaning they rely on a functioning economy to have a value attached to them. If we look at how currency resets affect economies historically, demand goes way, 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 way down, because nobody is really looking at, okay, how can I invest in the next data center, or what are transformers going to be doing? I mean, I understand that there's going to always be a need for infrastructure, but the demand drops off a cliff. And because of that, since there is no financial aspect to those metals, historically they drop down in value, so they're not performing a purpose. And so we wouldn't want to put anybody in that kind of position where we told them, hey, yeah, buy some copper, it might have some use, for your barter position. And then it didn't, when you could have actually got silver instead of that copper and added that to your barter position, where, again, historically, the silver is going to battle the hyperinflation for you. And then I think we have time for one more. Okay. So Elaine S. 5179 says, how can you state gold and silver have no counterparty risk so blithely and use fear by a proven counterparty, the government, to recommend pre-1933 gold? Please explain. So gold held at home privately, according to the BIS, is what has zero counterparty risk. Silver still has counterparty risk, and if you're talking paper contracts of gold and silver, that has counterparty risk. Bullion, gold, we can just go by what the definition is right now as having no counterparty risk. But Elaine, that can change, right? With the stroke of a pen, that zero counterparty risk could actually now have some counterparty risk. And so it's kind of like we have to weigh the scales, okay? What if we're right? And what if we're wrong? Well, if we are right and the government does what governments have been doing for centuries, if not millennia, and they nationalize their financial commodity to pay off their debt that they racked up because of a financial system that you nor I have any control over, well, then having the pre-33 gold is that safety net. And what if we're wrong and somehow, some way, things are different this time? That's perfectly fine because you're still holding a tangible asset that is in a long-term, positive, upward trend that also falls into a different bucket from bullion, and that's not a bad thing. It's not a bad thing to actually know what your options are and what your asset can do for you, right? It's kind of like, I don't know, I think I read one time, somebody said, did you know if you have a piece of land and you bury a family member on it, you can now change the tax code of that piece of land because it's technically a cemetery now. Not everybody knows that, but it probably has some upside potential with it. Same thing with pre-1933 gold. If you have the option to have some upside potential, regardless of if there's going to be a confiscation or not. Well, I mean, if you're wanting to be strategic about things, why wouldn't you at least look into it? So that's the explanation, and again, we just go based on what history shows and options, okay? Options equals freedom. Because when you have choices, you can choose what you want to do. That's freedom. If you have no choices, that's not freedom. So I think that was a great question, though. I think that was a good one to end it on. But yeah, appreciate everybody coming in, tuning in. It was a great time and hopefully a little enlightening. And we'll have Lynette back on here soon. And until next time, stay watchful.